Welcome to Opto Sessions, where we interview the brightest minds from the stock market, uncovering their secrets to success. If you're looking for ideas, tips and techniques from the world's best, you're in the right place.
Welcome back for another episode of Opto Sessions. Today I'm joined by Joe Kunkle, or Options Hawk to his 67,000 Twitter followers. A former equity analyst at Thomson Reuters and founder of optionshawk.com, Joe has made a living identifying the stocks others miss, digging deep to find that next small cap destined for household name status. Are options actually the most flexible way to trade? Is this where the smart money is? And can you follow options flow to track big money moves? Joe reveals all on today's podcast. Hello and welcome. I'm Hayden Brain, editor-at-large at Opto, and today I'm joined by Joe Kunkle. Joe is the founder of optionshawk.com and runs a subscription service providing premium market analysis. Joe is also the head research analyst and portfolio manager at Relativity Capital. Having managed both institutional accounts and his own, Joe previously worked as an equity analyst for Thomson Reuters and has since been featured across numerous media outlets, including Seeking Alpha, See It Market, and many more. So, hello, Joe.
Hi, Hayden. Nice to join you.
Thanks very much. So I wanted to start with just talking about your career and your background, and I was keen to get an understanding of how you got to where you are today. So if I could just start by asking what your first job was in finance or investment management.
My first job right out of college was with Investment Bank and Trust, who was acquired by State Street later. It was more of a corporate actions, back office role, looking into mergers, acquisitions, and all different types of corporate actions.
Yeah, and you studied investment management at university, is that right?
Yeah, so I mean, I did my bachelor's in finance at Bentley, which is up in Boston, and then I moved after graduating into Boston University. I did a master's in investment management, which is pretty unique and focused program straight on investment management. There really wasn't anything else like it around the country, so it was really fit what I was looking to do.
Yeah, sure. So, I mean, you were obviously quite set on your career and what you wanted to do from a fairly young age. What kind of drew you to investment management in the first place?
It was just always a passion of mine. I think back, like in high school, we had for football, we had 3 practices a day. We called 3-a-days, and you'd stay for the morning and mid-afternoon one, and then you go home, and most of my teammates would take naps, and I'd be tuning into financial television and just kind of soaking stuff up as a sponge. And then I guess some of it might have been in my blood, so to say. My mom's grandfather worked on Wall Street, and my parents weren't super active investors, but they understood finance and they were involved in the stock market. So I was surrounded by it at a pretty early age, and just kind of something I always looked forward to doing.
Yeah, sure. And then you went on to work as an equity analyst at Thomson Reuters. Is that equity analysis has kind of been a prominent theme throughout your career. Is that really where you sort of developed and honed your analysis technique?
Yeah, I think that, and a combination, just the background at the BU program, but at Thomson Reuters, kind of came on board there working on a new product that was basically covering the markets, mainly focused on the equity and option markets. And through that, we were, in discussions with lots of the top hedge funds around the country and everything else, developing this product, and pretty much kind of gave me the ideas for what I'm doing now, and really was like the starting point. And then it also just provided a lot of background and really good experience.
Yeah, sure. So then obviously you went on to kind of actually manage accounts, both institutional and your own, if I'm correct. When you were managing institutional accounts, and maybe you can tell us whether you're still doing that and kind of how that's played out. What sort of markets were you trading then?
Yes, I mean, I've always managed my own accounts. That was kind of my focus. And then also did some of these, what they call like hedge fund backer agreements, where a fund would just kind of back my trading and I'd trade for them, and they'd cut me a share of the profits. And with that, I was using the same approach I use now, tracking options flow and trading both equities and on the options side of the market. And more currently, it's just managing mostly my own accounts, as well as providing research role to Relativity Capital, which is our managed accounts company.
Yeah, sure. So do you have a preference between the two, sort of managing institutional accounts and I guess other people's money sort of versus your own?
Yeah, I mean, I don't know. I wouldn't say I have a preference, but I feel a lot more comfortable with my own just because it feels like a lot more pressure to perform for others and just not wanting to disappoint people, and when people have faith in you and they put in, you're doing your best always and putting your hard work in and you just want to show the results. So it's just definitely a lot more pressure and tend to be a little more conservative than on my own accord, because if it's just me, I'm like, oh yeah, it's okay. I can lose money and I know I'll recover it back, or I have lots of earnings power remaining in my life. And, so it's definitely a completely different mental battle.
Yeah. And I guess you have to conform to that person's objectives, I suppose, whereas you know your own objectives and you can be fairly flexible on them.
Yeah, it's very hard to, especially if you have a pool of clients, to be, they have their own objectives and risk parameters. So you're dealing with multiple people as opposed to just knowing, yourself as well as anybody. So you know exactly what you can look for and try to withstand. But yeah, it's definitely a completely different playing field.
Yeah, sure. And then just on the options hawk side of things, so what you kind of currently focus on, you're providing sort of institutional level analysis there. But you as we've discussed, you worked as an equity analyst at Thomson Reuters, and that's kind of throughout your career formed a big part of your day to day. So why the focus on research? Is that something that you think you're particularly good at? Is that where your edge is, kind of being able to do the homework on these companies?
Yeah, I definitely do. Research, I mean, it's always been my passion and kind of the core of my trading decisions. It just keeps me disciplined, having to constantly do the work. And I've always been a real hard worker and pretty disciplined with everything. So I put in the time, and just discovering great companies has always kind of been my focal point and where I've really excelled. I can really dig in and find these companies when they're, smaller market caps that turn into these, companies now that everybody recognizes. So just the whole process, and it also just has a real good feeling at the end of, you see your results from the work you put in.
Yeah, sure. So based on that, then, what would you say makes a good analyst? What sort of characteristics?
I think being open-minded is just one of the real main things. I always see people and they'll put themselves in a box. I'm a technical analyst, I'm a fundamentalist, I'm a macro. And I mean, to me, why not use it all? Why not, learn everybody's perspectives? And the more knowledge you have, the better informed decisions you're making. So just being able to, dive into each type of methodology and being able to also just think outside the box and have some foresight, looking to the future, kind of that whole go to where the puck's going to be, not where it is now. And just, always being future minded.
Yeah, sure. Well, I think that quite nicely sort of covers your background, and I want to move us sort of quickly on to options trading, because obviously that's your focus. But I'm conscious our audience, or not all of them, will know what options trading is and the benefits that it gives traders. So I wondered whether you could give us a quick précis of how option trading differs from trading the underlying equity.
Yeah, I mean, obviously it's a subject matter that could probably write a couple 100-page book on. So to keep it as concise as possible, I mean, an option is just a contract that gives you the right to buy or sell the underlying asset at a specific price before a certain date. And I mean, the main usages of them are via income strategies, speculating on directional, and also as a protective and hedging risk. So I mean, that's the real cut and dry version of what an option contract is without teaching a lesson,
Yeah, sure. So then why options? Why did you decide to focus on that? What do you like about it?
Well, I think my draw to it was just that probably the ability to, especially when I was young, it's not having a lot of capital, but being able to utilize that capital and make bigger returns on a percentage basis. But I mean, now that I'm more educated on it and experienced, flexibility is just the great thing with options. I mean, you define your dollar risk, you know exactly what you're willing to risk, you know what you can make. And even on the other side, for people wanting to make like negative bets against companies, you don't have to worry about borrowing or the borrow rates. You can bet against companies easily. And unlike equities, where you either are betting on it to go up or down, options, you can do tons of things. You can make money on something going nowhere by being short volatility, or or vice versa. So it's just the flexibility of it, and just all the different structures just opens up so many different opportunities.
Yeah, sure. So I mean, yeah, you mentioned the flexibility there, but would you also say it could be argued, at least, that it's a less risky form of trading?
Yeah, I mean, if you do it right, I always go back and forth on that, because sometimes I'll see people say it's less risky because you're allocating less, but you can also quickly lose, on a percentage basis a lot quicker than you would on an equity. So it's all about being aware of that. And when you are taking on an options allocation, you do it at the percentage of the equity. So your value at risk is, either less or similar. So you definitely have to define your risk and not make the same size trades. So if you're putting 50,000 into a normal equity long, say, you don't want to be putting 50,000 into the options line. You want to probably the 1/100th of the contract, so like $5,000 position, say. But just being able to know you're defining your dollar risk, because on a percentage basis you can obviously quickly lose with options as well.
Yeah, sure. And I guess then, as a result of that, it's quite accessible. I mean, you talked about it when you were younger. You didn't have necessarily the startup capital that others might further along in their career. So, I mean, firstly, would you agree with that? Do you think it's quite an accessible route into trading?
Yeah, I do. And another way to look at it too is with especially now. I mean, we've been in this market that's risen for a decade, and a lot of the great companies out there, say Amazon, Apple, and all these, Google, they're trading at $1,400-$1,500 a share, $2,500 a share. They're not they're not doing splits really. So that's a lot of allocation just to have one share of Amazon. You're paying $2,400, 10 shares, you're 24,000. Within the options market, you can define exactly how much money you want to risk without having to take on a huge capital position and still being able to generate those kind of returns. So it's really helpful with high dollar stocks, I find.
Yeah, sure. And so I guess then that leads me to the question of why don't more people trade options? I mean, at least in your opinion, do you have sort of thoughts on that?
Well, I think I would say maybe a year or two ago. Before that, I just think it was deemed more risky, and people are still kind of stricken from the financial crisis. Whenever they hear the word derivative, they want to run. And it's still kind of like that on the money management side today. A lot of people, is just, when you mention you want to trade options in their portfolio, they do, oh, that's risky. They just have this assumption that there's a lot more risk with it, because it's more of a perception thing with media. And there's stories that come out, and the negative ones tend to stick in people's mindsets over the years of what could go wrong with derivatives. But I mean, if you're looking now at the exchange data and all that, and Goldman Sachs put out a nice study too, but all indications are people are starting to trade it a lot more, and it's replacing a lot of the equity volume now. But I think just the longer learning curve of it has kept a lot of people away a long time. But I guess now people have a lot more time at home, so maybe more people will be interested in studying and learning more financial techniques. But so now I think the trend is definitely still continuing now towards more people trading it, and the volumes are definitely showing that. Although a lot of that's on the institutional side, but I believe on the retail side we're seeing the same thing, according to the brokerages.
And do you think the US are a little bit ahead of that? I mean, relative to the UK, for example.
I mean, I really wouldn't know. I have no real idea what kind of trading's happening in Europe or overseas. But definitely in the US, I think, based on the people I talk to every day in my industry, there's definitely a lot more interest in the options field. And I mean, for the options hawk business, it just keeps growing. So there's lots of more people taking interest in this style.
Yeah, no, that's great. I mean, that's really helped me to sort of get a better understanding of it, and hopefully it has for our listeners as well. So I kind of wanted then to tackle your trading strategy specifically. I mean, yeah, as we've discussed, options won't be for everyone. But during a time of sort of unprecedented volatility, is now a good time to trade options?
I mean, normally we would say like volatility is an option trader's best friend because there's just a ton of opportunity. The ranges expand. There's, faster profit making, especially if you're short-term trading and focused on that. It hasn't quite been so with the current market just because this unprecedented volatility also came with a complete lack of liquidity. So it's been nearly impossible to trade individual names through March and a part of April just because the bid-ask spreads have been so wide and there's just not a market being made out there anymore. And if you're trying to trade, it's really tough to get quality fills. And if you're just trying to, if you're not disciplined and paying the market price, you're going to get a lot of bad fills, and I call it slippage. So right away, you're kind of starting in the hole just from not getting a good fill at the price you want. So it's a lot harder to make money when you're not getting that kind of, the right price.
Yeah.
So there's opportunities with mispricings versus theoretical value too, because it's been so crazy, but the computer algorithms are kind of hunting those out and taking them out of the market as fast as they can.
And so that's on sort of individual equities. Are there any other sort of assets then you're having to look to sort of make up for that lack of liquidity in the sort of individual equity market?
Yeah, I mean, what we have actually seen because of this is that there's been a ton more trading in the ETF and index options. So like SPY and the NASDAQ and obviously the VIX, but even some of the sector ETFs. But it seems like that's the area where there's been better liquidity. So that's where a lot of the trading volume has really started to surge because it's just a more efficient market right there right now.
Sure. And are you sort of personally invested in that side of the market and the more sort of passive side of the market?
I mean, I don't do a ton of work on the ETF side. I tend to use them. I find ETFs are good for hedging, whether it's index or if you are in a volatile market and say, you do your research and you find the best semiconductor stock that you want, and that's the one that you're long. You can pair it with a short, the SMH trades very liquid on the option side, which is the semiconductor ETF. So using the index and sector ETFs more as a offset, like for hedging towards individual long baskets, is where I mostly would focus.
So then if we move to, as we discussed, we're seeing unprecedented volatility at the moment, and we're still sort of very much on a downward spiral, it would seem. But then if we look ahead towards a kind of longer term market revival, what do you think that might look like? Do you think a sharp recovery is in store?
Yeah, I mean, it's hard to say. It's just right now we've almost completed a V recovery. It's come back a lot further than I expected. I mean, without getting too technical, we basically came up and we almost touched the 200-day moving average on the S&P, which is always seen as a critical level. So starting to roll back a little this week. In my opinion, we just about around 2,900, we pretty much hit the top of the trading range that I was kind of expecting on a bounce. So we'll see if we can move back above 3,000. Heck, we might get back to new highs quicker than expected, but there's just so much uncertainty out there right now, and it's being expressed from every company that comes out with earnings this week that it was just hard to imagine. I saw when we got to the top of the range between that and also being at record high valuations, it was just tough to imagine it extending much higher than it currently did this week when we got just about to where kind of saw the top end of this range.
I've spoken to a lot of people that are seeing this initial rally as just that, a kind of a minor upward tick before we head further downwards. I don't know whether you have a view on that, whether actually this is more a short-term uptick before we head down, or actually we're kind of headed up for the longer term.
Yeah, I mean, I try to predict less and react more just because I find that people making lots of predictions tend to look foolish a lot, but it's, if I was to say, I mean, if you just look at the news and the uncertainty, you'd think, yeah, heck, we could go lower, but then it's all being almost offset by unprecedented fiscal and monetary stimulus as well. So we're in a time, there's no real playbook to look back in history even. I mean, we've had corrections before in history, but we also haven't had interest rates this low when we were correcting. So there's like a bunch of forces pushing against each other, and I would expect more to just kind of trade sideways until there's more certainty about the situation. And if we get, better news that the economy is reopening up and things are looking good, I mean, a vaccine obviously is probably like 12, 18 months out. If even that would be the major good news that can really recover this thing. But I think there's going to be more of a choppy trade the rest of the year. And then we have the election uncertainty. So it's kind of how the, even with the volatility has come down recently, the VIX futures kind of showed that they continue to kind of rise in September and October around that election time frame. So there's plenty of risk left in this market, and with the valuations where they are, it gets a lot harder to find opportunities and values, especially coming 20 to 30% off the lows in the matter of 6 weeks or whatever it's been.
Yeah. So, I mean, yeah, it's almost impossible to be sort of certain on anything apart from that there will be further volatility. I wondered whether you were trading the VIX at all, whether you were trying to sort of take advantage of volatility specifically.
Sorry, did you say if I was trading the VIX?
Yeah, exactly.
No, I don't do too much trading in the VIX. I've never really found it as a very as a great instrument to trade. I mean, it's popular in some areas, but you really need to have a kind of a deep understanding of how it works, and it's just never been a focal point of mine. I kind of stay more to the individual companies.
Yeah, sure. So we've touched on it a couple of times, but I wanted to dig down on what you think, at least, or in your experience, the ideal time frame in which to trade options is. I imagine it differs from trade to trade, but is there any sort of overarching lessons our listeners could take for the ideal time frame to trade options on?
Yeah, it's not like a one size fits all. It kind of goes down to each person's individual strategy and trading plan. But I tend to be someone that kind of targets a specific catalyst, and then I adjust my time frame accordingly to capture that catalyst, whether it be earnings or a conference or just an overall view of a period where I think the market range could expand. Which any option trader also has to always be aware of theta, which is time decay. So that can hurt option buyers, but it can help option sellers. So there's, like we said before, flexibility. Some people, depending on time frame, if you're a buyer or a seller, you might have a different time frame. At the beginning of the year, there was a ton of opportunities intraday trading options because of the weekly options were becoming extremely liquid and being offered across almost every company now. And I was doing a lot of options flipping, which is what I call for these very short-term trades, just based on technical triggers, just looking for a 15 to 25% move, which when you talk about equities, it's like, wow, that could take weeks, but options, I was doing this in, 15 minutes to, 120 minutes. I had a ton of success just flipping different contracts multiple times per day, but that's kind of eradicated now that the stuff's not as liquid and there's just not as many opportunities. But yeah, there's so many different strategies and limitless amounts of approaches you can take. It just kind of involves coming up with a plan and your objectives and going from there. So I guess that's a long-winded way of saying there's not a specific time frame I recommend, but once you have your plan, you can, with the flexibility options, you can pretty much target any amount of time frame you want.
So then, sort of sticking to how you prefer to trade, when you enter these positions, are you looking for a specific risk to reward ratio?
On the option side, yeah, I mean, you should always, I think, look for at least like a 3-to-1 reward to risk. So often for me, that's kind of like looking for 100% gain, so doubling the option contract price, and versus maybe a 30% loss, so a little greater than 3-to-1 is kind of my sweet spot. And like I say, it's specific to each person, but I tend to focus kind of on like 40 to 65 delta options. I don't do as much in the, the really far out of the money stuff that might be like a 15 to 25 delta. Although there you can see some really great returns if you catch it right, but they also will decay fast because it's all extrinsic value. So there's no real intrinsic value to it if you catch the wrong side of the move quickly.
Could you dig into that? Actually, that's not a term that I'm familiar with, so I'm conscious some of our listeners might not be as well.
Which term?
The delta.
So the delta is just the amount that it's kind of how much the stock moves for the given $1 move in the equity. So it's a 65 delta. The contract is expected to move 65 cents. But I mean, there's some other factors involved like gamma and theta. So it's not a perfect relationship, but it's basically showing you how much the contract will move for a given $1 move in the equity.
Yeah, sure. So then what's your strategy for taking profits?
I mean, I guess it probably applies to everybody. It's probably the hardest thing to do, selling, because definitely selling too early has always been something my whole career, and I'm sure it's with everybody. Just trying to be perfect is really hard in this game. So I always try to go by the approach that we're not trying to catch the 20 or 15 to 20% of the bottom of a stock or the top of the stock. You really just want to catch that 60 to 70% middle meat of the pie type deal. And so you really got to try not to be perfect. And I usually recommend some type of rules-based approach, usually on a technical basis. I like to use like a ATR, so average true range methods, like a chandelier exit. And then you can just, once you're on the momentum and the trend of the side of a trade, you can, slowly raise that up. And then other people like to take a much more simpler, effective approach, like just target a certain percentage return and, move on to the next one. And there's also partials that you can, partially move out of positions and in certain chunks. And another big part of options trading is the ability to adjust. So if you have a big gain on a call contract, you can leg into a call spread, and just by selling it, out of the money call against that call, and then you're locking in a portion, or you could lock in a definite gain on that position. The same applies if you own a call or put and a stock moves after hours on earnings. You can buy or short the equity versus that to lock in a portion, or guarantee yourself a gain in case it moves differently overnight or before the open the next day. That alone would be able to roll your positions out to a new expiration, new strikes. So you're sitting on a call contract that's worked well for you. We'll just, as an example, if you own the 50 strike and you've made 100% of it, you can roll it out to the 60 strike of the next month. So you've taken a portion of your gains off, and you could lock in your initial investment, but still have a rider to make more returns on it if it continues in your favor.
So you sort of finding you're having to enter a lot of sort of shorter term positions because of the lack of liquidity in the market that you talked about earlier, and obviously to take advantage of any opportunities that are resulting from the unprecedented volatility that we're seeing. Has your strategy become a bit more opportunistic in this market than it has done previously?
Yeah, it definitely has. I mean, I always kind of adhere to the approach that when volatility expands, your time frame contracts. So in our recent investment letter for Relativity Capital, I noted that I'm currently utilizing the Muhammad Ali playbook. So float like a butterfly and sting like a bee, meaning, I'm staying very active and only striking when opportunities arise, and just shortening up the time frames, because there's a lot of the movement we've been seeing since this correction happened too, which is another reason why listeners should probably be interested in options. Is a lot of it's been happening overnight with gaps. So we'll gap 2 to 3% down, and if you're just an equity trader and you get a stop in, hey, guess what? Your stop doesn't work overnight, and your stock opens well below your stop, so you're slipping your losses and your risk parameters are expanding. while if you own puts to protect, you already defined exactly where you're willing to, get out of the name, and exactly how much you're going to lose. So I think that's been a huge benefit to being into options during this time for sure, is that almost all of the movement we're seeing is overnight. So you can protect much better than just a stop strategy on the equity, which isn't as effective in this environment.
No, I see what you mean. So are there any industries or sub-industries that you're sort of keeping your eye on amid this sort of unusual market?
Yeah, I mean, I think basically all this has done is kind of accelerated a shift into the new economy that we've slowly seen evolve the last couple of years. But now it's just, with the work from home trends and everything else, it's just kind of accelerating what was going to happen and take time, but it's just happening at a quicker pace now. So, I mean, a lot of my favorite themes and companies, they still apply to this environment, and they're working in their favor. So most of the opportunities I've been finding is in tech, because we're becoming a service economy and technology oriented. So there's, whether it be software or internet based, there's a lot of opportunities in tech for disruption to continue, and just that whole digital shift. Same applies to the payments industry, shifting to digital from cash. And outside of that, healthcare, I always kind of focus on, because people are always going to get sick. The demographics of the aging society, there's always going to be need for, pharma drugs, biotech, definitely in this time with the pandemic, and as well as medical technology, which has taken some hit on the elective side, but that's very transitory and near term. But longer term, medical technology has just always been one of my core interests, and it's been a great area to find growth. On the other side of that, you talk in industrials and some of the consumer discretionary areas and transports, a lot of the stuff that's more macro correlated, that's going to struggle for a while, and we're not going to have a lot of clarity. So kind of goes this thing of, people will ask, well, this is a good company here, but it's in the, if it's in a bad sector though, it's like, why try to make money where it's hard to make money? Let's focus on what's working, and, there's easier money to be made in names less impacted by not only the current events, which is kind of like a once in 100-year type thing, but whenever there's a macro downturn, there's certain themes, industries, sectors that can, still perform very well despite the environment.
Yeah, sure. I wonder whether you could give us a few examples of some of those companies within the sectors that you picked out, so either tech or healthcare, just to give our listeners sort of a flavour of the sort of equities we're talking about. Even I know because of the level of research that you do, you're probably in the know or across some of the smaller cap companies that our listeners won't even be aware of. So if there's any of those sorts of equities that you can highlight, that would be really interesting.
Yeah, I guess if we go industry by industry, or there's just a lot of great companies. One I wrote about for you guys in November was Teladoc, which I saw as the future of healthcare, just being with telemedicine. And now that a lot of people are home, and even our doctors for our kids are having us, instead of coming to the office, they're just doing telemedicine visits over the phone. So that's just a huge industry, and had complete scarcity value because there's no real other way to invest in that theme outside of that stock. And you have your players like Slack, just very good for collaborative teams, all these people working from home. It's going to be a lot of that going on, that they need to collaborate and have a place to go to share ideas and documents and everything else, and stay on top of things. A company that reported last night that I really like is Bandwidth, and the ticker symbol is BAND, Band. They're actually up quite a bit today. It's this company I own. They're in the CPaaS space, which is kind of an offshoot of software, but with communication technology. So it kind of ties into Slack and Microsoft Teams and all that, their technology. And then on the medical technology side, Dexcom's always been one of my favorite names. It's disrupting the diabetes industry, which the trends there are just, outrageous. So they have the best technology, and even when that's not something that's kind of elective, they've been pretty insulated from this whole sell-off and done very well. video games. I mean, gaming's not slowing down, and there's a lot of positives in that industry, whether it be like micropayments or the whole shift to online and digital downloads increasing their margin profiles. So Activision's probably been one of my favorites in that group. Yeah,
Sure.
I mean, I could go on forever. I have a lot of companies in my brain, but
No, I mean, that's really interesting, and you've written about these companies on Opto for us. We get an article sort of every couple of weeks from you, and we're actually collaborating on an ebook. You're writing sort of some of the sub industries and sectors of the market that you think might be interesting during this sort of upturn post sort of pandemic chaos, and that'll be out soon as well. So we'll dig a lot deeper into some of the companies that you mentioned there, and some others as well. So our listeners and readers can look out for that. I just wanted to dig into your process really, because there's a lot of kind of smaller companies there that you will have mentioned that people won't have heard of, and I'm certainly interested to know sort of how you come across them. What's your process for finding out more about them? Can you talk to us about that at all?
yeah, so I mean, a lot of it's just being very, aware, and I mean, I track everything. So I'm watching them every earnings release after the market, and if I see something stick out, and I'm looking at the growth numbers, etc., then I'll dig into that company. But I mean, from the ground up type perspective, I'm often just running screeners based on financial metrics, whether it's the growth or profit margins, or I don't, with a lot of these smaller growth companies, I don't really have a real issue with their valuations. I won't do a lot of valuation screening because they tend to grow into their valuation, and I'm looking for companies that are going to grow for years and years. So mostly on the growth side, looking at what their revenues have done, and finding companies in just, and then also from a top down level, finding companies in industries that I like. So like the themes we've talked about, and drilling down more into that. So if something's working, then you're like, oh well, yeah. Like I found quite a few interesting medical technology just with this COVID-19 thing. Like Masimo's, they're big into the patient monitoring, and then yeah. So I mean, I screen them down, and then once I have these listed companies, I'll dig into them deeper by reading over their management transcripts, looking at their investor presentations. You can start with a 10K and look at really the basics of what their business is, who their customers are, and just learn about the company. And then you also want to learn about their industry and the available market that they're targeting, and then you want to learn about their competitors to make sure that they're gonna be the company that thrives. So there's a lot of different approaches, but just doing the groundwork, grind and research, and just really diving into it.
Sure. I mean, yeah, it sounds like you're certainly an advocate for doing your homework, I suppose. That last point about sort of competitors and making sure that, I guess, that they have some sort of differentiation against their competitors within whatever sector or industry it is. Are there any particular sort of fundamentals or even just characteristics of a company that you look for that are assigned to you, that they are different enough that they will stand out and outperform?
Yeah, I mean, you can do like comparative analysis and looking at market share, and on a very simple level, of the companies generating revenues at a much faster rate than a peer while still having equal or better profit margins. That's a management team. They're doing something right. I mean, you can drill down deeper into other metrics that will analyze how well a management's doing, like return on invested capital and things like that. But yeah, there's actually, even aside from that, finding one of my favorite things is to find a company that has a real good niche. They're focused on one area of a really good industry, and there's just not a lot of competition in the area. Plus, it's that whole thing goes back to scarcity value, that investors want to be involved in a certain theme that's growing really fast, and there's just not a lot of avenues to do it. So it's a simple allocation of capital type deal that can boost the stock for a long time. There's a lot of companies like that in software where there's a specific niche now. Like there's like Avalar is a really interesting company that, they do like financial software for e-commerce companies to remain tax compliant. And so finding a niche company is one of my favorite things to do too.
Sure. And then whilst we're sort of talking about specific equities, I wonder whether you could tell us about your best or just a favorite trade.
Wait, you mean like over my history?
Yeah, or just one that sort of sticks in the mind from sort of recent memory.
Yeah, I mean, I'm not like great with remembering good and bad trades. I kind of have that quarterback mindset that they kind of teach you to have a very short memory and don't think about the last play and, think about making the next play great. But with that said, I think my favorite trades are being involved in call options when an acquisition deal is announced and being in the acquired company. So I often use options flow to find these kind of signals. And that was a few years ago. It might have been 2016 where I might have hit like 15 to 20 of these merger acquisition deals where I was always in calls. So it was insane. But then in 2019, I only caught a handful. So it's an up and down type thing. But yeah, that's definitely my favorite when you just get that morning pre-market news and you're in one of these names, whether it be the stock or the call option, and they're getting acquired for a nice premium, because that's the thing with options. I mean, you can make 5-10x your money in a day on one of these, and it kind of offsets if you lose here once in a while.
And then on losing, then is there a trade that sort of sticks out as a worse, or one that particularly hurt?
Again, it's not. I won't have like a specific one. I try to always keep losses small and stay pretty disciplined. But there's times where I'll speculate on an earnings move and lose 100% of the position, the next day. But with that, I'm fully prepared to, and willing to lose that position. So I allocate the amount of capital to it accordingly. But my worst trades in equities always tend to be in energy and commodities. It's just a group that has real no rhyme or reason to me for daily fluctuations. They pretty much trade with the underlying asset, and there's not a big bifurcation between the members of those groups. So I tend to thrive at finding the best in class companies in clear trends with secular tailwinds, and in there it's more of just a crapshoot. You have to understand the commodity and macro much more.
So I wanted to pick up on this idea that obviously not everyone listening will trade options after this interview, but some might be. So I wanted to dig into how an options strategy can complement an equity trading strategy. And secondly, even if an equity trader isn't trading options, can they learn something from options flow?
Yeah, I'll answer your first question. First is the just as a complimentary, that's one of the great things about options that people should almost always be using. There's income strategies like writing covered calls against your positions where, you're taking in extra money on your position, and even if you don't want to get called away, you can always roll that position and adjust it. So that, and along with put sales, is a very effective mean of, defining exactly a price where you're willing to buy an equity, but you take in a nice premium, and sometimes you don't buy and you just get that capital. And it's actually in mid-March, when I pretty much right at the market low, I wrote for Opto CMC. We put together like a portfolio of quality companies where I saw opportunities because of the high volatility to sell puts out longer dated, say December 2020, January 2021. And, you're defining really low levels where not only the valuation becomes great, but it's just would be an amazing level to own it if you have to own it. All of those have rallied a ton, and not only do you benefit from the stock moving up, but the volatility has come down so much that pretty much none of those positions will ever get put, but you can buy them back now at much lower prices, so you collect that profit. Now getting into this, also for the complementary is just protective strategies in general. We talked a little before about the ETFs and being able to hedge sectors against your long stocks. There's also, broader market hedging, which you can do with index puts or put spreads or however you want to do it. And on an individual basis, you can, if you have a stock that's run a long way and you don't want to just sell calls against it, you can collar the stock so you're also protected on the downside, which would be selling an upside call and buying a downside put. So you can try to, I usually with collars, I want to get into them at a, pretty zero cost or a net credit so that you're not outlaying anything, but you're protected on the downside and you still give it runway to move to the upside. And then just on your second point, I think equity traders can have a huge benefit from, a site like ours and following options flow. It's one of the things I always stress, and the tech, I use it a ton. 75% of my trading is probably equities. The options flow is just something I use as an initial signal, of what the smart money is doing, how they're positioning. And then I do the research to dive into the why they might be doing this to find the compelling investment opportunities, which you can do via the calls or equity, any instrument really. I take a broader approach monitoring, because I'm looking at these option flows every day across pretty much every name. So I'll find overall market signals based on how the flows are trending, as well as like industry specific thing. It could be a time period where I'm seeing multiple refiners or multiple gold miners receiving unusual call buying, and it tends to give you really good signals and with that directional flow.
And then, so we're talking about sort of a group of traders trading underlying sort of equities, and then you've got your option traders on the other side. There's people out there doing both, I suppose. Are you one of them? Do you do both, or do you kind of mainly focus your time on the options trading side of things?
No, I definitely do both. I tend to recommend to people that are looking to, have larger option trading portfolios, that even with that, not to allocate more than 25% of your capital of the overall portfolio to options. Also to, especially on the directional side, the income strategies and the complementary strategies, they're tied in with the equity portion of the portfolio. And just trying to keep the number of open positions manageable is important too, because there's a lot more to watch with an options portfolio, because you have to be aware of, the volatility and the time decay and gamma and all that. So it's just, there's a lot more to be mindful of. So it's not as easy to manage.
Yeah, that's something I hadn't considered actually. Sort of time management must be a massive part of options trading. Is it something that people can do part-time, or is it really actually something you need to be monitoring sort of day in, day out?
I think the time you have to put into it kind of determines the strategies and the approach that you would take and the activeness. So if you don't have a ton of time to put into it, you probably want to be looking maybe at, a bit longer dated positions. You don't want to be, putting weekly options and anything like that. And you can also, change up your strategies instead of solely just doing simpler long call strategies. You can, you can make volatility bets. You can sell iron condors and expect the stock to stay in a range. There's just so many different approaches, but I think based on the amount of time you're willing to dedicate to it kind of determines which strategies you should use and what time frame you should be targeting.
And then, so during this current climate, this current market, is there an argument to say that options traders are kind of more resilient to a downturn because you don't hold 100% of the underlying asset?
Yeah, I think they fare a lot better just too because of kind of how we were talking before, with a lot of the overnight movement too. They're able to be protected a lot better than an equity trader that just has a simple stop loss that isn't relevant anymore when the market opens. So I think just having that and that safety net and being able to be hedged and be more confident when the market's going down, because you have these hedges in place, really definitely makes them much more resilient and ability to stay real nimble and generate offsetting gains from their hedges.
And then, so is that something you personally benefited from sort of during this downturn, that extra layer of resilience?
Yeah, that and just my activeness. I was just real nimble. I had a lot of my signals I used that pretty much in late February was telling me to get into safety, whether it be cash, bonds, gold. And as much as I wish I was short equities or long put options much of March, there was fairly tiny window that I saw to really pull the trigger before that liquidity issue evaporated and volatility soared. So once that happened, it was like it happened. I mean, this move was unprecedented speed, and at that point, the appeal of the puts just became so less attractive, and it was just a difficult environment to be confident because you're paying a ton of premium at that point to try to get into puts. And I mean, and then those people that at that point panicked and did that, they're hurting because we rallied back and everything kind of, those puts decayed. So you just got to be real patient after a move like that happens. And it's just something I try to do.
So as a final question then of the main body of the interview, are you more positive about the outlook for the market now? Are you more risk on than you were, like we were talking about sort of a month ago, or are you still pretty cautious?
No, this week I kind of started getting a little bit more cautious here, just as we kind of discussed before, getting to the top end of what I see as a pretty applicable trading range for maybe the rest of the year, or at least until we see more clarity. I mean, I monitor this stuff very actively, so the economic data is just terrible. I mean, but we knew that was coming too, and we priced a lot of that in ahead of time. So there's that counter, and there's the Fed and the ECB and the BOJ counter, but just the opportunities on a valuation perspective they started to dry up here as a lot of names have moved, and a lot of my favorite names are, almost back at where they were at the beginning of the year, trading at record highs. It's just not a lot of opportunities, and I'm definitely, I'd say I was 1 foot out of the door coming into the week, and looking at the market today, I'm about to get 2 feet out of the door.
Sure. All right, then. Well, that's probably a nice place to end the main body of the interview. I just wanted to finish with some quick fire questions. So just a sort of light-hearted way to end the interview. You can answer these in as little as sort of one sentence or even one word if you like. So the first one, in your opinion, what's the top mistake investors or traders make?
I think just trying to be someone you're not. You really just got to find your own niche, your own style, and come up with your own custom plan, and not try to copy what somebody else is doing. And one of my main mistakes is kind of giving the market too much credit and thinking that it values news faster than it actually does. So I take profits too fast a lot. So if you have a great idea, just kind of stick with it. And not only that, be willing to allocate a larger percentage of your capital when you find those real great ideas, and try to really hone in on a few great ideas and not try to, spread yourself too thin.
Yeah, sure. Yeah, some good advice. So the second one then, where do you go for your investment or your business insights?
I mean, honestly, I don't find a lot of time to read the work of others. I've always been kind of a self-made, do-it-yourself type person. I mean, one of the reasons I named myself my company Options Hawk was just kind of the spiritual meaning of the hawk, having a higher vision and intuition, and being able to see things from above, and patience, and having foresight. So just trying to stay focused on what we do, and I pretty much rely on our research for my investment insights.
Yeah, sure. So what gets you mentally sort of ready and set up for the day as part of your morning routine?
Outside of coffee, I'd say just knowing that I have a large group of people that are depending on me to put out research daily and cover the markets. It really keeps me disciplined, and knowing that people depend on me keep me in that path, that I'm not going to ever slip up and be like, oh yeah, today I'll get out of bed late, I'll just try to trade what I see in the market. No, I'm always going to get up at 5:45, 6 a.m., gather all the news I can, look for opportunities, and just stay on top of things.
So what's the most memorable moment from your career today?
I wouldn't say there's a particular moment. I just think the entire journey has been memorable and probably is yet to culminate. I mean, I started the company, my wife always laughs, is I found a desk and a chair on the streets of Boston someone put out for trash day, and I set it up with a laptop and a monitor, and and I just kind of went from there, and it grew. And now that my 2 kids are kind of past the newborn stage, I'm looking to do some real exciting things with the site and scale the business and really generate an awesome research platform. So as well as having ambitions in money management and financial writing space. So I think there's a lot more for me to do here, and we haven't hit the peak of my career yet.
So then a final question, what would be a top tip for your younger self?
I'd tell my younger self to take more risks, especially when you're young. You have a long window of earnings power. Money lost can be made back, and money itself isn't all that important in the grand scheme of things. Allocating, like I said, larger percentage of capital to your best ideas and letting them play out. Other than that, I'd say just read, whether it be books, transcripts, investment letters. The age of the internet, there's so much valuable content out there, and even media platforms like Twitter, you can really connect to some really insightful people and learn from them. And just having that willingness to learn and be a sponge, it's well worth the time. I've always said I'll read a 400-page book, and as long as there's even one sentence in there that kind of sticks with me and something I can apply ritually, whether in life or trading, that book was well worth the time and money.
No, that's fascinating. Well, that brings us to the end of the interview. It's been really great for me. I've found it really interesting, and I'm sure our listeners have too. So thanks for joining us, Joe.
Yeah, thanks a lot. I look forward to continue writing for you guys and putting out some content for your readers.
Thanks for listening, everyone. Just a quick note before we sign off. If you're looking for an easily digestible daily update on the markets, this might be of interest to you. Opto Updates is our short newsletter sent every day during a trading week, giving you a bulleted list of the top 7 stories from the global stock markets. We've done the hard work for you, highlighting relevant opportunities and trends, and in addition, we'll also keep you notified of any new podcasts, stock reports, or events from the Opto world. If you're interested, sign up using the link in the show notes. Until next time.